Hello guys, welcome to the sharpening session for today. Today is July 31st, it's a Saturday. Markets are closed, or most markets are closed, which is why we do sharpening sessions over the weekend. So it gives us a little bit more time to just expound on concepts and explain things in. And I'm just checking the chat boxes to see who's around and who wants to say hello and who is with me today. Of course, as always, whatever sessions we're in, I want you guys to ask questions. I want you guys to interact and let me know what is help you. That's especially important with sharpening. So hopefully what I was going to go through today, if you guys don't have questions, because sometimes you're a bit quiet, if you guys don't have questions, I have a plan for today to go through why you may cancel a trade. Now, this is something that we've covered before, but I'm getting that question a lot, so I think it's something that would hopefully be helpful for a lot of people. So, before we do that, let's just cover the disclaimers. There we go. So they are coming up there on the screen. Of course, important to read disclaimers for legal reasons and also to understand that these types of connection might not be great, which means I might be dropping in and out a little bit. Still follow the point and follow what's going on. Now let's have a look here at what the agenda will be. We're just going to go through lectures, trade plans and reviews. In this case we won't actually look at any specific trades, we'll just go through some questions. Now these questions have come from and thank you to Steve. Steve, you've been asking a lot of questions here on tradewithufos.com/Becky. I think in here where you can ask questions. So once you've got a free Trade with UFOs membership, this is where you can come to ask questions. And then if you scroll down, these will be previous questions. Now I've just thought of something for a second, guys. If you give me 1 second, I'm just gonna turn off the screen for a second, just whilst I try and fix something, and then hopefully we'll end up with a smoother situation. So give me a sec here. Okay, so that should, there you go, that should have fixed our internet problems here. So hopefully I'm now streaming and it's making a lot more sense for those of you that are following. So apologies for that initially. Okay, so we have questions that have come through on to this tradewithufos.com/Becky. Now, there are brilliant questions, and again, thank you to those that do put them here, because what's great about that is you can see the questions, you can see the answers, but so can other people, which means other people might have similar questions to you and they can come and get the answer here, rather than send an email or watch through videos and maybe wait a little bit to get that answer. They've got it here initially. Now, sometimes it's a really great question and I will use that as an opportunity to then be able to expand on it, especially in these sharpening sessions. So that's what I plan to do today. Now, this is an example here of trading when price has already entered the UFO. So the question was, if we find a suitable setup but price has already entered the UFO, do we still take the trade but make it a market order instead of a limit order? So what I'm going to do is I'm going to go through a few of these questions and expand on them. And a lot of the theme of these questions is essentially, when would you place a trade? When would you not place a trade? When would you cancel it? What would you do when you're in it? What would you do if you're waiting for it? And things like that. So this first question is essentially saying, you've got a good trade, but price has already come into the UFO. You haven't yet placed the trade. Expand on that and explain it just here. I'm going to bring up TradeStation and what I'm going to do is try, we're going to have to draw it out. Let's draw out some examples here. So let's say we have prices going up. We've got a confirmed upwards climate, for example. We have a green UFO around about here. Price has gone up. The EMA, let's do a pink line. The EMA is now lining up. It's within that. Price has moved down and it's within the UFO right now. And at the time that we are ready to be looking at this trade and be placing it, that's the situation we see. We've got a thick blue dot. We've got the EMA lining up with our UFO, but price is already inside. What do we do? Now, there are a couple of things that we can do here. So we'll walk through the different examples. So first things first, and this was the suggestion made by Steve there in the question, is we go in at a market order. Now, very rarely would we go in at a market order because it means buying at whatever the price is right now, rather than a predefined price that is chosen for a reason. But it might just so happen that you're already within it, and so you go in right now at whatever the price is right now. So let's say, for example, let's say the entry price would have been 1.5656. Let's say the stop loss, let's change the color. Let's say the stop loss would have been 1.5610. Okay, let's just make that up. And let's say current price at the moment is 1.5650. Okay, so you're actually 6 pips, or whatever you're trading, let's call it pips. You are 6 pips into where you would have been placing the trade. And that's actually a great thing, because now, instead of risking 46 pips, you're now risking just 40 pips. So you're actually reducing your risk by doing that. And you get in right now, you keep the same stop loss, but your entry is a lower price. So great, you've got into that trade at a lower price. You've bought something cheaper than what you could have. We love that in life, we love that in trading. You can do this, and there's absolutely nothing wrong with that at all. Now, another thing you can do is you can still set a limit order to catch on way out. There might be a more succinct way of explaining that, but let me explain this here. A limit order to catch on the way out. Now, what I mean by that is if price is at 1.5650 and the entry price was going to be 1.5656, then you could place the trade to still be at 1.5656 with your stop loss at 1.5610, where it was going to be anyway. And then that way, if price just continues down and goes through the UFO, you never got into the trade anyway. It wasn't a loss. It would have to go back up, and essentially you'd be catching it as a breakout then. It would have to go back up for you to get into the trade at all. If it doesn't go back up for you to get into the trade and it just continues down, then you saved yourself a losing trade because you would never have been in it. If it does go out, then you catch it on its way up, and you've already mentioned that it's moving out there. So let's just balance these things out. The benefits of going in at a market order is that you get it at a cheaper price, and that can be easier for you to hit your targets, hit your one-to-ones, hit your ratios, because you've got a smaller risk. That's a benefit of that. You get a better price. Now, a downside of that is that you're definitely going to be in the trade, of course, which means if it loses, it loses. A limit order to catch on the way out is the opposite. If it continues to go down and you never get into the trade, well, then you just cancel it and you would have never been in it and you've saved yourself a loss. If it goes in your favor, then you've had to buy it more expensive than you would have if you'd gone in at a market order at some point in between those two lines. So it's going to be harder for you to reach your ratios. 1-to-1, if your zone is 50 pips instead of 40 pips, well, then your 1-to-1 target is going to be 50 pips away rather than 40 pips away. So it's harder to reach. So you've got pros and cons to each. Ultimately, it's up to you to decide which of those makes the most sense to you. And the most important thing here is, and a lot of times with trading, people want the answer to be, do this. They want me to tell you, do number 1 or do number 2. The beauty of trading, I think, is that there are different choices that we have here. There are different things that we can do depending on how conservative we are and what we value more. If we are an extremely conservative trader or an extremely risky trader, either side, then you're going to pick different ones here. And you're going to have different choices along the way. The most important thing is that you choose one and you stick with it. If you sometimes do number one and sometimes do number two, you will be behaving in a way that is not consistent. And if you're behaving in a way that is not consistent, then you are probably getting results that are not consistent, and it'd be hard to figure out what's going on. So pick whichever one works for you and stick with it. That would be my advice. Okay, so I'm just checking if there are any questions or anything like that. So if you, just checking something there. So if you have any other questions, if that doesn't make sense, let me know. But what I'll do now is I will move on to another question, again on our tradewithufos.com/Becky. We'll move on to another question and start answering that. But of course, if you do think about it or you go, wait, hold on, that doesn't make sense, you just let me know. So let's have a look at important to check trend. Let's have a look at that one. So when looking at a potential trade, should we first check the trend of the higher time zone or just focus on the climate indicator? Or does the climate indicator take trend into account? Now, a great easy answer to this one is his own question there. The climate indicator takes trend into account. Now, there was another question. I couldn't see it on that list there, so it might have come through email, but let me use this as a way to answer this question. If we are using our climate indicator to take a trade, because it's essentially telling us that is the trend, that is where probability lies, then we may use that to get out of a trade. So let's come back to TradeStation and let's explore that right now. So let's say, in this case, we have a thick red dot here. So what we're going to do, let's move price like this, and we'll use UFOs that are already on the chart here to make the point. So in this case, we have a thick red dot. That thick red dot tells us probability is downward, the trend is down. We should be looking to sell. That's what that Auto Climate app is telling us here. Now we also have UFOs. Let's assume that the EMA is lining up with these UFOs. And so therefore these UFOs, we might bunch them together and that will be a trade that we take. Now, let's say, and let me just draw some lines really quickly around this area to make the point. So let's say, for example, we've worked it all out and those two black lines are where we're getting in and out. And let's say we have a target here. Again, you would have worked this out properly, but it's just to make a point. We have a target here, and of course we have another target round about here, okay? So this would be our trade in theory, right? Again, we're making up a lot of the numbers and things just to make a point. Now, as price moves up, few things can happen. As price moves up to approach our trade, it may be that before we hit our trade, before we hit our entry, the climate, because price is now moving upwards, not downwards, it may move far enough upwards that the climate's going, we no longer have probability down here anymore. And so instead of it being a thick red dot, it becomes a thick blue dot or a thin dot of either color. At that point, if this happens before the trade enters, we cancel the trade. Because the first reason that we ever would have gone to place this trade is because we have a thick red dot. It's because we have probability down. If we no longer have a thick red dot, in any case, whether it's gone to a thin dot or it's gone to the other color, then we don't have probability down anymore. If we don't have probability down anymore, then we don't want to be trading it. We don't want to be going short. We don't want to be selling if we don't have probability downwards. So we would cancel that trade. Now with this, let's say, for example, and this was the question that we had there from Steve the other day, what if price is within the UFO? You're in the trade, you've been triggered, you hit your entry, and at that point is when the climate changes. It no longer is a thick red dot once you're in that UFO. Then what do? You're already in the trade. The question was, and these were the answers, and again, very fair question. Number one, do you close the trade early? Or two, stick to your guns and just say, I was going to place that trade, I've placed that trade, I'm in it. Now that I'm in it, let's just see what happens. Again, there are different interpretations of this. And again, this is beautiful. I'll explain the different interpretations, explain the pros and cons. And then again, it's up to you to decide what makes more sense to you, what you value more. Pick one, stick to it. That's the most important thing. So if you close the trade early, so you've gone, I'm within the UFO, I no longer have the climate on my side, get out here. Well, if you get out there, you have lost less. Let's make up the numbers. Let's say you were risking $100 in that area. Well, now you might have only lost $60 because you've got out early. It's not gone to a full stop loss. So you've lost less than you would have if it goes against you. What's the downside of that? Is that let's say you get out there, if price was going to continue and go against you and stop you out, then okay, great, you've saved yourself a little bit of money. What if price still hits the stack of sell orders and continues to come down? You've then missed out on being in that trade. You've missed out on potential profit. Now, this is the pros and cons. If you stick to your guns and you say, right, I place this trade, it doesn't matter now that I'm in the trade, it doesn't matter that anything changes, if that was your approach, well then you don't get out there and you're still in this trade and perhaps price continues against you. And it showed you that it's likely to continue against you by the change in climate. So it's now stopped you out and you've lost the $400 if that's what you were risking. The benefit of staying in and sticking to your guns is that perhaps it moves in your favor and you collect your profit. So you've got, again, pros and cons. The more conservative way of doing it is answer number one, where we say we no longer have lining up what we need to line up in order to be in this trade, so we'll get out of it. And that way you lose a little bit. You're not risking in an environment where you've lost probability. The pro of that is that more often than not, if you did it that way, more often than not, you would have smaller losses. Sometimes you're going to miss out on big wins. So what bothers you more, really, is the question. Would you rather, and I'm making up the numbers here to make a point, let's say out of every 10 times this happened, where prices within the UFO and the auto climate changes, out of every 10 times that happens, 7 out of 10 times price is going to go through the UFO, but it's going to go to what would have been a profit. Do you want to be wrong 7 times in a row in order to make those profits 3 times? That might be multiples away and might make you money overall. Or would you rather avoid the 7 losses? Would you rather limit those 7 losses? That's your choice, depending on how risky or conservative you are as a trader or as an investor. The technical, strict answer is number 1, close out early. Auto climate has changed, therefore you no longer have probability in that direction, therefore cancel the trade. But understand that there may be times where you do that and price does turn and go in your favor and you're going to be watching what would have been a profit. So are you more comfortable accepting that, okay, I know it would have been a profit, but overall, if I did that every time, more often than not, it's not going to be a profit, so I'm okay with that? Or are you somebody that says, I'd rather be catching those big profits, even if it means I have to lose a few times to do it? That's your choice. That's up to you as a person and how you feel. If you make yourself pick one of these that does not sit well with you, with the type of person you are, you will not do it. You won't do it consistently. And the most important thing is that you're consistent. Whichever one of these you pick, you are consistent. You keep doing it. If you don't keep doing it and you change what you're doing all the time, results are inconsistent. That's not helpful. So again, hopefully that helps. We've now gone through 2 separate questions. We sort of expanded on that second question based on another question that we'd had similar to that, to give you an idea of when you might close out trades, when you might cancel trades, when you might leave them and when you might not, and why you might pick one or the other. Now, with these kind of sessions, as you know, we do these for free. They are streaming on YouTube and Facebook and LinkedIn and all over the place. They're also streaming within our closed coaching environment. Now, normally when we're in the live sessions and we are placing trades as we go, after we place one trade, at least will be when we cut the stream. So that might be 20 minutes in, it might be 40 minutes in. We cut the stream to the free environment and we continue in the closed coaching environment. Now, in sharpening sessions, it's not like we're placing trades, we're just going through concepts. So what I'll do today is I'll go through one more of these concepts, one more of these questions, then I will cut the stream, and then I will continue in the closed coaching environment to go through another concept. So again, it's fair to those of you that are paying for the coaching and for those of you that are accessing it free. Everybody gets something useful, but of course the ones that are in the closed coaching session get that little bit more. Okay, so again, any questions, anything that you don't understand, you guys let me know. Always keeping my eye on the chat box there. I want to make sure that you guys get it and you have, you take a lot from this and that it makes sense to you. So let's go back to our list of questions here and we'll have a look at one more before we expand on this a little bit further in the closed coaching environment. So choose where to start a backtest. Do you know what? I'm going to leave that till the next session that we do because I could talk about backtesting forever. So I know if I start on that, I won't stop before the end of the session. So we'll leave that one till next time. We'll focus on backtesting more next time. Now, question about using EMA. Let's have a look at that. Okay, so let's say I find a price chart where the common time frame EMA is a UFO band. So, or is in a UFO band, I think that means to say. So basically, where your EMA value is within a UFO on the smaller time frame. So that's from the bigger time frame, this is from the smaller time frame. They are together. Based on the methodology, we are supposed to set up a trade to trigger when price hits that band. Yes. However, what if it takes a couple of days to reach the UFO band and in the meantime the EMA is no longer in the band? Does that happen often? Would we cancel the trade then? Again, brilliant question. So let's go back to the chart and expand on this. So the methodology states, and let's put the EMA in this chart here so that we can make the point. So add study. A little bit slower today than usual, but that is my computer's fault. So we want EMA, so moving average exponential, there we go. In this case, MAE, same thing, exponential moving average or moving average exponential. Let's make it a different color and let's make it really thick so it's really, really easy to see. So we will make it, I know, let's make it like a bright pink or something so it's really easy to see. There we go. All right, brilliant. So in this case, we would have an EMA value which is 1820.9. Now, what we're going to do is we're going to delete some of these things and we're going to try and make a point. So let's say 1820.9. Let's assume then that we had a UFO here. Okay, let's say a UFO at this point and we'll make it red, of course. Let's do like a light red so it's easier, not brown. There we go, easy to see. Okay, great. So let's say we had a UFO here, so that coincides with the EMA. In fact, let's make it a little bit smaller to make the point. So the EMA value would be currently 1820.9. Let's draw this out and just again make the point, 1820.9. And let's again make the, let's make it the same color that we have on the other chart. Okay, great. So if that was the case, that we have our EMA in the US, but let's say as price moves up, it moves up over a couple of days was the question. It might be a couple of weeks, might be a couple of hours, depends on the time frames you're using. Let's say the price does take a couple of days to do that. And in the meantime, because the EMA, exponential moving average, meaning it moves with price, that average price has now moved up, which means so too has that line. And now the EMA no longer is within, it's now outside of our UFO, as price is coming to enter the UFO. So what do? The answer is basically cancel the trade. That's the easy answer to this. Now, you're cancelling the trade. Why? Because we need, as UFO methodology traders, we need three things to line up for us to be placing a trade. At least, right? We need confirmed climate. First thing. Second thing, we need a UFO. and or aligned, UFO aligned to climate. So in this case, it would be a thick red dot, so we want a red UFO. We have probability downwards, so we want to be selling. And then the third thing is we need EMA aligned to UFO. Those are the three things we need minimum to be getting into a trade. There are other things that might dissuade us from getting into a trade, even if these three things are hit. For example, if our final target is very, very close to us, we might decide that that trade's not worth taking. But more often than not, these three things are met, these three checkboxes are ticked, we get into the trade. Great. So if at the time you place the trade, these things all lined up, but by the time you were to get into the trade actually be triggered, in this case, this one is no longer happening. Let's use a red line here. Let's make this point really big. This is no longer happening. We no longer have an EMA aligned to the UFO. Therefore, we cancel the trade because we wouldn't have put it on if we were to look at it now. If you hadn't seen it 2 days ago and you were looking at the chart now, you wouldn't put it on because those three things aren't being checked in the checkbox. So you wouldn't place the trade. The same as if we had a change of climate. If we looked at it now and we saw a UFO and the EMA lined up, but the climate wasn't in that direction or wasn't confirmed, we wouldn't take it. So if any of these three things change before we get into the trade, cancel the trade. If you're following this methodology strictly and sticking to it exactly. If you are already in the trade and these things don't align, again, you might cancel the trade whilst you're already in it. Now that is actually only true for this one. So let's say, for this one, for the top one, because let's say you're already in the trade and then the climate changes. Well, the very first thing that we need to have been in the trade in the first place has now changed. Therefore, get out of the trade. Again, that would be the stricter way of doing it. That was the first example that we went through in this session. Again, you might be less strict on that, but if you were to be strict exactly, then you would cancel the trade if the climate changed whilst you're in the trade. Now, as long as the EMA aligns to the UFO when you're triggered into the trade, it doesn't actually matter if it moves whilst you're in the trade, because that's what it should do. It should move whilst you're in the trade, because if we take all of this off, for example, it should move whilst we're in the trade, because let's say, let's move this, let's say by the time we were triggered, the EMA is still within the UFO. So then, let's say by the time we're triggered, the EMA is still within the UFO, and then it starts to push price down. Well, we would expect that that EMA is going to start moving down. It's going to move away from the UFO, as it should do, because price is now moving down, but we're in profit. So we don't care if the EMA moves out of the UFO after we've already been triggered into it. If the climate changes when we're already in the trade, that might be a reason why you choose to get out of the trade. Oh, my battery is running low. I forgot to plug my my laptop in. If you guys give me 2 minutes, I'm just going to run away, get my laptop charger, because I don't want to be out of this session early and just cut it off sort of mid-sentence. So if you guys give me, I'll be 60 seconds. I'm just going to again turn these things off. I'll be back in 2 seconds just to plug my laptop in. Okay, that was quicker than I thought. I did actually have my laptop charger with me, but it wasn't pushed in far enough at the back. Anyway, let's carry on. So this was basically an example of the main 3 things that we need to be getting into a trade in the first place, and therefore what we do if those things change before we get triggered into the trade, and what we do if those things change after we're already in the trade. So hopefully, again, that gives you an idea of when you might cancel a trade and when you might get out of a trade when you're already in it earlier than expected. Now, saying that, that is assuming, so there's 3 things that we just talked about here. We want a confirmed climate, an aligned UFO, and we want EMA aligned to UFO. Those are the, in quick summary, those are the three things we need to ever be even in a trade. So this is assuming that you do all of those. You might be somebody that says, I don't use the EMA. In which case you only need those two things. In which case you don't care what the EMA is doing. You might be somebody that says, I need the first two, for example, I need the first two, but if it's aligned with the EMA, I place more risk on those trades, or I have further targets on those trades. It doesn't have to be, and this is the beauty of trading. I love this, and this is what I love about back testing, so you can go and test these theories to figure out what works best for you. It doesn't have to be all or nothing. The very easy way to be structured and strict and consistent is to just take that methodology and be strict with it and do it. Nothing wrong with that. We of course teach that, we do that. But if you were somebody that said, I don't even care about the EMA, I'm going to just take all of the UFOs that align with the climate. That's what I'm going to do. You would end up with a lot more trading opportunities than those of us that use all three of those things. Because you've now got a third less variables that need to be hit before you place the trade. You'd have a lot more trading opportunities, but the trades that you place would be, in general, less likely to work. Now, I've talked about this before, in that as long as they make money, you might be okay that they don't work as much, as long as it's still profitable, because you have more trading opportunities and you're an impatient person and you want to trade loads. You might be fine with that. You might be somebody that says, why would I have less variables and place more trades if they're less likely to work? I'd rather have less trades and trade once a week instead of 5 times a week, but I have more probability that that trade's going to work for me. And that's okay too. Either way, you could be profitable. It really depends on how much you make when you make it and how often you're right. You could balance the numbers in either case in order to make similar money or more in one category. But it's about you as an individual. How many losses are you okay to go through before you get a winner? If you're okay with that, then it's okay to lower your probability rate. As long as the numbers still work out that you're profitable, you might be fine with that. If you're somebody that's not okay going through a series of losers before you hit a winner, you might be somebody that wants to increase the probability rate and decrease the amount of trades that you place. And that's okay too. So these three things that we need lining up, you might be somebody that says, I need all three things. And in which case, if those things change on the way leading up to getting into the trade, I cancel the trade. If I'm already in the trade and the climate changes, then I get out of it. Or you might be somebody that says, no, I don't use UFOs. I just use the EMA. So whatever the EMA value is, whatever it aligns with, I don't care. I just take the EMA value. That's fine too. Again, you'll have way more trades than we might have. But more likely, those trades are less likely to work out. Overall, you might still be profitable. So what I'm saying here is the beauty of trading is that we do have this choice. But the more important thing is that whatever you choose, you keep doing that thing. If you sometimes align the EMA and you sometimes don't, then you are applying different things to the same thing. It's like, I like to make analogies to make a point. It's like if you were making a cake. You could make up a recipe yourself, throw things in a pan, see what happens. If you've never cooked before, you know nothing about cooking, nothing about baking, you don't take anyone else's opinion or help with that, it's probably going to take you a while before you happen to throw things in the right quantities before you get a good cake. But there's nothing wrong with that. You might enjoy the process. You might find an amazing way to do a cake that nobody else has thought of yet because you've just thrown things in randomly and kept a track of what you've done and found something that worked. Brilliant. You might be somebody that says, I don't know how to make a cake. I have a cookbook here with somebody who does know how to make a cake and they've told me exactly what to do, what the steps are and exactly what quantities it needs to be to make this exact cake. And you follow it to the letter every time and you make a lovely cake every time. Some people would say, I'd so much rather be that second person. Some people would say, no, I'd so much rather be the first person. What's brilliant about trading or brilliant about life is that you can be a combination. You can say, do you know what, for the first few cakes I make, I'm going to follow it exactly. Whatever the recipe says, whatever the cookbook says, whatever the expert says that wrote that, I'm going to do exactly that. But as I get more confident in it, I might add a little bit more sugar. I might add a bit of vanilla extract. I might chuck in a bit of chili powder. People use chili powder now with like chocolate cakes and things. I might put an avocado in there, whatever. I might try different things and see what works. And if it works, I'll keep doing that. And if it doesn't work, I won't do it again. And this is where we can come to with our trading. We can be really strict and follow all of the rules and do it exactly as it is. And you'll do fine like that. You could be somebody that says, I'm just going to play about and try all of these different little things that people are saying. I'm going to click this and click that, and eventually I'll find my way. That's fine. It's going to take you a long time, but hey, you might enjoy the process. Or you might be somebody that says, I get this structure, I'm using this structure. I'm the type of person that prefers to be in more trades. Therefore, I'm going to tweak it a little bit. And I'm going to run that for a little while and track how that goes. Or I'm going to backtest an idea that I've had. In an environment where you're never actually making the cake, right? You're just simulating making the cake. So you never actually waste your resources in that case, right? You're never actually placing trades and losing money to test a theory. You can do it in a backtesting world in order to figure out where you might come to this. So it might be, again, you might be somebody that says, confirmed climate, lovely. Aligned UFO, lovely. Those things have to be done. This thing is a nice to have. So if it doesn't align, no problem, I still place the trade. But instead of risking 1% of my account, I risk 0.5% of my account. If it does align, brilliant, I'll risk 1% of my account. So for the trades that have higher probability, you risk more money on them. For the trades that have lower probability, but still enough, you still place the trade, but you use smaller risk. Or maybe you say, for the trades that tick 1 and 2, my target is 1 to 1 away, my safety target. For the trades that hit 1, 2, and 3, my safety target is 2 to 1 away, 1.5 to 1 away, whatever. You can mold with this and play with it. You've got the recipe. The expert has written the cookbook. In this case, that's Jose, right? He's written the cookbook. He's written the recipe. It works. You can just follow it. Or you can play about with it a little bit. Test it in an environment where you're not actually risking real money, so that you can find the way that works best for you, in the way you feel about opportunity versus risk versus probability, and what balance of those things work best for you to be consistent with your actions and therefore your results. So I know I've harped on about this point over and over again. I will always, it's to me, it is the way that we should be thinking about the markets. There are so many people out there that will teach that only their approach works, or that their approach is the absolute best and everything else is rubbish. I'm not going to tell you that. There might be loads of other approaches that are great, and loads of other ways of trading that are completely different to the way that we do and that would make you money. And there's nothing wrong with exploring them if you want to explore them. You could be somebody that says, I've got this cookbook, I'm sticking with that cookbook. You could be somebody that buys 50 different cookbooks and tries all 50 of them. I'm not going to tell either one of those people who's right or wrong. Ultimately, it's what works for you. We teach you the way we do things that works for us. Mold it, play with it, stick with it, ignore it, do whatever it is that makes the most sense for you as a trader. But most importantly, if you are playing around, if you are testing different things out, try and do it in a back-tested environment or a simulated environment. When you're actually then trading and placing these trades in real life and risking money on it, then ideally what you want to be doing is saying, I've played about, I've got my recipe, now I'm doing that recipe 100%. Not sometimes this recipe or sometimes that or sometimes this or sometimes that, based on random, I just feel like it. You might have a different recipe for a different cake, that's okay. I swing trade like this, I day trade like this, I invest like that. I trade futures like this, I trade Forex like this, I trade cryptos like that. That's fine. But if you're day trading cryptos, for example, you want a recipe, a set of rules that you apply every time, not different rules that you apply willy-nilly. You get to that set of rules however you get to that set of the rules. copy the recipe that someone else has given you, play about with your own recipe, whatever. But once you're actually trading, you stick with that, you don't change it. Pick the answers, the different examples that I might give you, pick the one that makes the most sense to you and stick with that. And change it every time you trade. Otherwise, you'll have no idea what it is that's working for you and what isn't. So I've made that point now. I think I've gone on maybe a little bit too much about it, but hopefully that makes sense to you guys. What I'll do now is I'll cut the stream to the free platforms, YouTube, Facebook, etc. And I will continue in the closed coaching environment, and we'll go through one more question on that tradewithufos.com/Becky link. If you guys, anyone watching on any platform, if you have questions, please do, because it's really helpful, I think, for these kind of sessions in particular. Please do go to tradewithufos.com/Becky. If you're already a member, then you can come straight to this point. You can post a question here, and then I can answer it there, or I can do a whole session on your questions, which Steve has been benefiting from more recently. If you don't have a free Trade with UFOs membership, you can come to the top here just to fill in these boxes, fill in these things, and then click through the steps for you to get yourself your free Trade with UFOs membership. And then you can obviously ask a question there. You can book one-on-one coaching with me as well if you want to from that link. So I will leave you guys on those free platforms. I will be back with you on Monday morning, Monday afternoon, wherever you are in the world, for our 3D market commentary. So I'll see you then. Hopefully you enjoy the rest of your weekend. And for those of you in the closed coaching community, give me a second whilst I cut off this stream, and I will see you guys in a second. So bear with me, she says. Okay, see you later, guys.